Afternoon, this is Lance Bryce with Thrive Mortgage. Today is Friday, the 17th of March. Hope you're doing well. Well, we have seen some crazy volatility over the last couple of weeks. We have seen interest rates, frankly, moving a little over a half a point just in the last 2-week period, both up and down on an almost daily basis. And again, the volatility in the news, I know everyone's aware of the bank failures that we are seeing. That was a bit of an unexpected wrinkle that has hit what had become a fairly predictable Fed pattern. When we would get inflationary improvements, we would see rates come down. When we got inflationary news that was either in line with expectations or a little bit worse than expected, then we would see rates go up. That's a fairly predictable pattern that we've talked a lot about as I've done these calls. Let me give you the numbers on where we are now. Mortgage News Daily, their daily tracking poll on a 30-year fixed conforming has the national average at 6.55% today. Last Friday, that same index was at 6.76%, so we're a little bit less than a quarter of a point better than we were last Friday. 30 days ago, we were at 6.80%, so we're about a third of a point better than we were this time last month. But y'all, a couple of weeks ago on March 2nd, we had ticked up to 7.10. So we had seen a pretty negative reaction to both the employment numbers and the consumer price index, which came in as at expectations. Bond markets had been hoping that some of the prior reporting around both jobs and inflation would get revised and we'd see a more friendly number to bonds. Didn't get that. We saw CPI come in at expectations on Tuesday. We would have expected the bond market to sell off pretty severely on Tuesday as a result of that, and we did see volatility. But then we got the SVB, the Silicon Valley Bank failure that really dominated the news cycle and is still doing so today out of concerns that that may spread to other banking institutions. Concern also about some European exposure, what they're doing for Credit Suisse to keep it afloat. And this has drawn into question what the Fed's going to do. The Fed meets, announces their next rate hike, or their next rate decision rather, on the 22nd next week. So it's going to be interesting to see what they do. Do they go contrary to what they've done in the past? They've broadly communicated, and the markets were fully expecting a half-point increase in the federal funds rate at their next meeting. Do they now back off of that in the face of these bank failures and maybe go 25 bips? Do they take a pause altogether? Markets broadly expecting a 25 basis point hike in the federal funds rate at the next meeting. But wouldn't be shocked to see them say, no more, not for a little while. We're going to see how this hangs out in the banking sector. That decision, if they were to make it, is probably a bit unlikely because that would convey its own degree of panic. That would convey its own degree of concern over the banking sector that could bring about the result they're trying to avoid. So they've got a very careful balancing act at this point as far as setting expectations for the banking industry. I also wouldn't be shocked to see the Fed stick with what they've communicated to the markets and go a half a point. If they do, we're going to move off these prices sharply higher. We're going to see a pretty significant sell-off in the bond market if that were to occur. Because again, the markets are expecting the Fed to moderate in the face of this banking issue, the banking concerns that are out there. And if they fail to do so and stay the course, then we may see some sharp revisions in current pricing. In any event, we would like to see some improved numbers to share with y'all, but rates are holding steady and pretty stubbornly at that 6.5, 6 5/8 level. Would like to see something move the markets to break them out even lower. And I will keep you posted if that happens. All eyes on the Fed for next week. Happy St. Patrick's Day. Y'all have a blessed weekend. Stay safe. We'll talk to you next week.